Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about index investing and specifically what you may not know about it. Alex, I don't know about you. I don't know how many times I sit down with a client and, they tell me they're index investors, which is fine. It's not necessarily bad or wrong or good. It's more of understanding what that means. And when I dive deeper into it with the client's like, oh, I didn't realize that, right? So there's just so much unknown knowledge, I think, or understanding, or maybe misunderstanding about this topic.
Yeah, no, I actually love hearing I'm an index investor because it means that like half of the stuff that I'm going to talk about with them, they already have at least some idea or concept behind, which is great. There's just usually a few things that they're like, wait, it works that way? I didn't understand that. Why does it work that way?
Yeah, so let's define index investing. So I just Googled index investing, just curious to see what it actually says. And I guess it's a relatively easy definition here, which says index investing is a passive investment strategy that aims to replicate the performance of a specific market index, like the S&P 500.
Yep.
Which that's index investing. But what's really interesting about that is when we go deeper into that and we talk about, we've gone over the steps of investing, and one of those steps is diversification. Right. So let's just talk about the S&P 500. Maybe that's the index that you've invested in. Maybe that's the only investment choice you've got, right? Which we see oftentimes. Or maybe we see like the S&P 500 and then we see maybe a target date fund or something like that, some version of the two. But they don't realize what the target date is invested in versus what maybe the index investment is.
Right.
And so when we talk about the S&P 500, and I'll share my screen here in a minute, Alex, here. So let's define the S&P 500 for everyone first and foremost.
Sure. It's the largest 500 companies in the U.S.
And when we look at that, like what do those companies represent, right? Like what type of companies are those when we dive deeper into that?
Yeah. And so like it's dominated by what's being termed the Mag 7 or the Magnificent 7. So we wind up with usually an outsized portion towards information technology or tech in general. It doesn't necessarily always come across as tech because when we actually take a look at it, some of the stuff like Tesla, it doesn't necessarily wind up showing up as tech. It shows up as like manufacturing.
Right.
And like most people would argue that nope, Tesla is much more of a tech company than they are a manufacturing company. Although, like, again, you can make arguments for a lot of this stuff one way or the other. And what you're showing on your screen right now. So for anybody who's just listening to this, go ahead and jump onto the YouTube channel and take a look at it. The bottom 300 holdings of the S&P 500 are roughly half of the index. And when we take a look at how big of a piece Apple, Nvidia, Microsoft, Amazon, and Meta are, like it is a massive, massive portion of the S&P 500. When we wind up adding to that, what are we missing there in terms of the Google's not there, and then what's the other? Oh, and Tesla.
Google's not there. Tesla's not there either, right? And this is as of December 31st of 2024, right? So this does change, right? Which is a whole nother part of our conversation that we need to look at here. But what's interesting, and I think a lot of people don't recognize, is yes, you're invested in 500 companies, but the way this index is investing, as you can see, you've got these 6 companies that are making up 50% of this index, which means if one of these companies has a down year, there's a possibility that the entire index has a down year.
Yeah, I mean,
because of the size.
Right. This isn't showing all of the holdings in the S&P 500, but what it's doing is it's showing the top 5 holdings and comparing it to the bottom 300 and saying that there's equal weight between the top 5 and the bottom 300, which winds up bringing into question how much diversification is there in the index. Yes, you've got 500 unique holdings. However, it's driven by the top 5 to 10 holdings, where we wind up with a massive piece of the portfolio. 30, 35, 40% of the portfolio can be inside of those top holdings, depending upon where exactly you draw the line and what it looks like. And so ultimately, while yes, you're diversified, and I'm using air quotes, at the same time, it is so driven by those big holdings. And the S&P 500 is what we call a market cap index, meaning that the bigger a company is, the bigger weight it has in the index. And this is tacitly saying bigger is better. And fundamentally, you and I disagree with that in terms of how we go about managing assets.
Well, yeah, because when you consider, and I'll just kind of jump to that because we've done this before, but I think it's always important to, we even go through this with clients multiple times, right? Like when we look at um, the market and we look at, what is it, the last 49 years, when we look at different asset classes, what's really interesting about this is, and I'm going to change this down to $100,000. If you were to invest $100,000 starting in 1973 and you were to put that money in an asset class, right? US large stocks, this is like the S&P 500. So the money
Yeah.
would have grown, and it grew to 16 million, right? And you can see the last several years, it's done rather well. 2019, 31%, 2020, 18.44%. So it's done 2021, 29%. Those are great numbers. But what a lot of people don't recognize is if they chose small companies, now it's at $46 million, right? And then if they went to small value type of asset class, now it's at 113 million, right? And we would never say to invest all in one asset class. Let me be clear about that. But when we think bigger is better, that may not be the case, considering Apple wasn't always the size it is today. And when was the better time to invest? When it was smaller or when it was bigger?
Right. We constantly hear people, especially around where we live in Washington, say, "Oh, I wish I would have invested in Microsoft in 1985 or 1990 or whenever they think about it." And Microsoft wasn't the behemoth that it is today back then. It was really relatively small. And so a large portion of the growth and the value that was created by Microsoft was investing in those early days. And we don't get that by investing purely in a large index like the S&P 500.
And then going back to diversification, right? I'm just going to kind of go to, 2000, 2001, 2002, right? 2000, the S&P 500 is down -9. US small value is up 24,
Uh-huh.
right? 2001, it's down -12. US small value is up 23, right? What's even more interesting, 1999, right? The S&P 500 is up 20, but did we know that international value was up 33, almost 33%? And so this comes to the diversification. And even if you look at what's going on in the market right now, Alex, right? Like the S&P 500 is down right now, but if you go look at international equity, it's up double digits.
Yeah.
This is where diversification is so key. And yes, could the S&P 500 beat the international? And we're not even going into comparison around like individual asset classes. It's more of like a diversified portfolio helps limit the down in the market as when we are concentrated, whereas most people right now, they've been concentrating the S&P 500, understandably so from the standpoint of where the rate of return has come from, but because they chase that return and they're in the S&P 500 index, for example, now the entire portfolio could be down, and now it comes into behavior and all of that kind of fun stuff.
Well, and one of the things is what people are being taught. Like they're being taught like things like, oh, active investing no longer works and just buy a passive index and things of that nature. And yeah, buying passive is a good thing, and not paying exorbitant fees is important. That's built into the philosophy that you and I have. And at the same time, just because something has historically done well over the last 5 or 10 years does not mean that it's going to continue doing so. Like every financial ad you ever see always has the disclosure past performance does not dictate future returns. And the reason for that is it's true.
Yep.
Like we can just go back to the 2000s and the S&P 500 was down for an entire decade, whereas other portfolios were up. And so it's one of those things where investors oftentimes have very short memories. The important part is to reduce down your fees, but truly have a well-diversified portfolio and not just invest in what has been hot lately.
So I'm going to throw something out there. Like the people that are listening to us right now, maybe even some of our clients, they might be thinking, okay, Ryan, Alex, I get your point. We can't just invest in the S&P 500 index. But what if I have a percentages of all these indexes in a portfolio? So I've got like 6 or 7 index funds. So I'm diversified. Is that the right approach to go?
I mean, maybe that's going to
Is
be
that, or is
better.
that, it's going to be better? But to Alex's point that he said earlier, are you invested? Are you thinking in the index? Is it a bigger is better type of investing? And the question is possibly so, depending on how that index is looking, and it's going to change over time.
Yeah. What's your view of the market? Like, do we want to invest in bigger companies? Do we want to and how do we go about identifying how much should go into small caps or mid caps or value versus growth, domestic versus international? All of these questions start popping up. And the more that we add different components, the more challenging it becomes. And now, not only do we have to figure out, like, okay, what are we investing in? But how often are we rebalancing? What's our mechanism for rebalancing? How do we go about doing that? What are all of the other components that we need to think about? And like there have been a few times where, and I know you've come across this too, Ryan, where someone goes, "Oh, I'm diversified. I have 10 different mutual funds."
Yep.
And we plug it into a software like Morningstar, and like, yeah, they've got 10 different mutual funds, but the overlap between them is like 80%. And so
Hey, did you know that all these mutual funds really you're invested in the name the index, right? Look, I've got all this, right? But it's all small cap, or it's
right.
all right. Like it's all
Or it's all
invested the
large
same
cap
way.
or what. Yeah.
Exactly.
And so like, it's one of those things where we need to actually like open the hood and look underneath and see what's actually going on so that we're not just replicating what we've got, or even worse, paying someone to now replicate an index.
Yeah.
Like we need to make sure that we're truly diversifying, and we understand what the philosophy is and why, and how are we creating better outcomes through a diversified portfolio instead of just throwing darts at a wall.
Yeah, and this conversation stemmed, at least for me, Alex, was I'm on social media and I just kind of I'm just a spectator and I see all of these like I forget what they called it. Essentially, their index it's index and hold, right? It's hold the S&P 500, and that's all they do. Which that's a way to invest, right? And on some level, it's better than not investing. But it's do you actually understand what you're investing in and the risks associated with it? And I think that's the piece that most people don't quite grasp. Like the last meeting I had with the prospective clients, they had 2 huge takeaways. Takeaway number 1 is they didn't recognize they had a huge amount of money in the S&P 500. They didn't recognize that a lot of their money is in like 5 companies. They thought they were diversified, but they now that they understand how the S&P 500 is and now it's market cap weighted, now they understand that piece. The other piece that they didn't realize, I went down just kind of the academic side of stuff, and I showed them this small value asset class, and they're like, "Oh, whoa, what is that?" Like they didn't. No one talks about it, and they haven't been talking about it because it hasn't performed the greatest in the last decade in comparison to the S&P 500. It's done fine. It just hasn't done exactly what the S&P 500 does, and it kind of got lost. but we're not investing for 10 years.
Right.
We're investing for long periods of time. When are you going to know to shift? And that's the issue. And that's where they had this aha moment of, okay, I need to look at this at a more academic look and not just an index only perspective.
And I mean, if we take that one step further, Ryan, we wind up with these conversations around like, okay, why are we getting the advice that we're getting? Well, because it looks good. And every time the market shifts and changes, we have a new thing to talk about and sell and way to create transactions. And what does Wall Street want? They want transactions. The more transactions that they can create, the better, which is one of the reasons why this concept of S&P and hold resonates with people, is because it flies in the face of this.
Yep.
And it's still falling short of having a truly diversified portfolio. Don't get me wrong. We love driving down what's called turnover ratio, driving down the amount of change inside of the portfolio as much as possible. The less that we have in the way of transactions, the better off we are. And the way in which we create those transactions also matters. So if we can go ahead and rebalance in a strategic manner, as opposed to selling a bunch and buying a bunch, well, then we're going to be able to do better by taking inflows or outflows and using those dollars to rebalance. And that helps the portfolio, and it reduces down costs. It reduces down a bunch of different factors when we're actually using those methodologies to create and to invest.
And I'll end on this note. People are freaking out right now, or people that are wanting to retire are definitely freaking out because a lot of their money is sitting in the S&P 500, or it's maybe sitting in a couple of these asset classes we've spoken into, and they've been chasing that return train. And now that it's time to start taking an income stream from their assets, and how they've been really have not been diversified the way that they thought, now they're second guessing it. So again, this goes back to, yes, we want to get an efficient rate of return, but the key word is we want it to be efficient. We don't want to chase. And when you're chasing it, you're setting yourself up possibly for what's going on right now. And now you're questioning, crap, can I retire? And people we work with, they don't want rate of return to make or break when they get to retire. So I think we'll end on that. So we hope this episode is valuable for you. If head over to beermoney.net, and at the top of the page there, if you have any questions from today's episode, there's a contact us spot. It's a great way to reach out to us. Or if you have a topic on your mind that we have spoken about, that's a great way to reach out to us. Look, we started this podcast to help hopefully bring some education and bring some action items to you to help you become more financially savvy so that you can live the life that you want. We hope this episode was valuable for you. And Mr. Collins,
Make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7966389.1, expiration date May 2027.